Hello and welcome to the class of your ACCA Financial Accounting. Today we need to start a new chapter, which is chapter number 13, Capital Structures and Financial Cost. So in this chapter we need to understand what are the capital structure and how they are financed and what are the accounting adjustment that we need to do for different types of capital structures. Okay, so let's start with the topic of capital structure. But before starting the capital structure, we need to revise something from our chapter number 1. In chapter number 1, we have discussed the different types of business entities. So what are the types of business entities? What are the types of business entities that we have studies in chapter number 1? So there are three types of business entities that we have studied, which was sole proprietorship, then the second one was partnership firm, and the last one was the limited liability company. Last one was the limited liability company, which is also known as LLC. So there are three types of business entities: sole proprietorship, partnership, and limited liabilities company. What is sole proprietorship? Suppose there is a one individual person who has started his business. So that individual person is the sole proprietor of this business. Suppose if I am starting my shop, so then I am the sole proprietor for that shop. What is partnership? Partnership where two or more than two person come together to start a business. Suppose me and another person comes and starts a business, then it is known as partnership firm. And last we have limited liability company, which is separate legal entity in the eyes of law, which is separate from the person who have started it. So there is three types of entities: sole proprietorship, partnership, and limited liabilities company. Now we need to understand what are the capital structure for all these entities. So we need to understand the capital structure for different types of entities, or for types of entities. First of all, we'll start with the sole proprietorship. First of all, we'll start with the sole proprietorship or the sole trader. You can name anything. So suppose I am starting a business by my own. So what are the sources of capital that I can bring to start my business? First, I need to invest the money by myself, or else I can take the loan. So the first source is to use personal capital. Is to use the personal capital. So whatever the amount which I have, I will bring it in the business, which is my personal capital. And the second source is to take a borrowing, or you can also go for the loan from the market or from the bank. So there are two sources of capital structure, which are personal capital and borrowing from the market or borrowing from the loan. Then in the second types of business entity, which is partnership firm, we can also have two types of source. First one is the personal capital contributed by the partner, which is personal capital contributed or bring by the partners of the firm. So contributed by the partners of firm. So this is the first source. Then the second source is same as the sole trader, which is taking loan or borrowing from the market or from the bank. So second source is borrowing and loan. So there are two types of sources, for sole trader and for partnership, which are almost same to each other. Then comes our third form of business entity, which is the limited liability company, which is the limited liability company, also known as LLC in the short. Now what is limited liability company? So limited liability is a company which has more people as their owner, which have share of the company. So this is limited liability company. Now what are the sources for limited liability company to get their capital. Okay, so sources for limited liability company is to issue their share to the general public so that they can purchase the share and give money to company as the capital. So first source is ordinary equity shares. First source is ordinary equity shares. Then comes the second source, which is preference shares, So first source is to issue ordinary equity share, then come the preference share. Now what are equity share, what are preference share, we will discuss later. Then the third form, which is the same as sole trader in partnership, which is borrowing or the loan from market, or also known as loan notes. So what are the capital structure for LLC? The sources for capital structure for LLC are taking loan or borrowing, then issuing ordinary equity share, or then issuing the preference share. So these types of capital structure are there for different types of business entities. Okay, so first we have studied what are the types of business entity, which is also covered in our chapter number 1. Then we have studied what is the capital structure for different types of entities, which are for sole proprietorship, for partnership, and for limited liabilities company. Then we need to understand that what are the topics which are there in our chapter number 13. So typically chapter number 13, this means this chapter focuses mainly on the capital structure of the limited liability company. The chapter number 13 focuses mainly on the capital structure of the limited liability company, where we need to understand ordinary equity share in detail, what are the meaning, what is the feature, and what are the accounting treatment. Then we also need to understand the preference share in detail, what are the meaning, what are the feature, and what are the accounting treatment. Then in the same way we need to understand the same about borrowings or loan notes. Okay, so these are the topics which we need to understand. Okay, so let's divide the capital structure for limited liability company. Okay, so the next heading is, and our primary focus should be on this only, which is capital structure for limited liability company, which is the LLC, Okay, now we need to understand what are the structures. As we have already discussed, there are three types of sources. First is to issue ordinary equity shares. Then the second one is to issue preference shares, and the last one is to get amount from borrowings or in the form of loan notes. So these are the three sources of capital for the limited liability company. Now when it comes to ordinary equity share, there are no such types of ordinary equity share. There is only one type of ordinary equity share. So these are the shares which are issued to general public, who are the real owners of the company, based on the number of shares they have. So whoever has the number of share will have that percentage of the ownership of the company. Okay, so these are the ordinary equity shares, which are treated as capital or equity for the purpose of accounting. They are treated as capital or equity for the purpose of accounting. Okay, then we have preference share. Which are of two types. The preference share are actually of two types. First one is the irredeemable. Preference share. Then the second one is the preference share which are redeemable in nature. So the second one is redeemable preference shares. Okay, so preference share are of two types. First is redeemable, second one is irredeemable. Now let's start talking with the first type of preference share, which are irredeemable. That means these preference shares are not going to be redeemed in any time near future. What are redeemable preference share? The preference share which are not going to be redeemed, which are not going to be redeemed. So these types of preference share are the preference share which are not going to be redeemed. As they are not going to be redeemed by the company, that means company is not supposed or is not obliged to pay back the amount to the preference share holder. They have issued their preference share and now they are not going to redeem it. So as there is no obligation to redeem this back, these preference share which are the irredeemable preference share are treated as capital or equity for the purpose of accounting. So they are treated as capital or equity for the purpose of accounting. In the similar way, the other types of preference share which are redeemable, What are redeemable preference share? These are the shares or these are the preference share which are going to be redeemed, as there is obligation by law to do so. Also, there is the obligation to do so because you are required to do such redemption in the real time. Okay, so there are two types of preference share. First one is irredeemable, second one is redeemable, which are the shares which are going to be redeemed or the company is going to buy back them in any time soon. Okay, so as company is supposed to buy back these shares or redeem them back, it is the liability for the company. Hence it will be treated as liability. For the purpose of accounting. So irredeemable preference share are the capital or equity category, but the redeemable preference share are of liabilities category. Then we have third source of capital structure for the limited liability company, which are borrowing or loan notes. So as the name suggests, borrowing or the loan notes, it is the loan taken for the company and hence it is going to be treated as liability only for the purpose of accounting. Okay. So what we are studying? We are studying the capital structure for limited liability company, where first we have ordinary equity share which are going to be treated as capital or equity. Then we have preference share which are of two types, redeemable or irredeemable preference share. Irredeemable preference share are going to be treated as capital or equity because they are not going to be redeemed or buyback by the company. Then there is redeemable preference share which are going to be treated as the liability as company is required to buy back them. Then last we have borrowing and loans which are the liability for the company. Okay, now we need to understand journal entry for each such types of capital structure. Okay, let's start with the ordinary equity share. So for ordinary equity share, there are something which we need to understand. There is the face value. There is something known as the face value of share. What is this face value? Suppose your share which was first issued to the original promoters are the face value of the share. Suppose you have the share for $1. You have the share for $1. Okay. So this is the value of share which was issued first time to the promoters of the company and at which they have deposited the or contributed the money to the capital of company. So this is known as face value. Okay. Then we have issue price. Then we have the issue price of share. That is the price at which share are later issued to the other people or subsequently issued to the public is known as issue price, which is typically higher than the face value. Suppose the issue price of the share is now $15. So whoever going to purchase the share need to pay $15, for which $1 is for the face value and the remaining amount is for the premium amount, which is the share premium, which is known as share premium, which is the difference between the face value minus the issue price, or you can say the difference between issue price minus face value. Okay, so for more clarity I'll write it like this, that this is the difference between the issue price and the face value is known as share premium. So in this case the issue price is $15 and the face value is $1, so the share premium is of $14. Okay, so these are the things which you need to understand before going for the accounting adjustment for the ordinary equity shares. Okay, now we have as this information. So what is the journal entry to record when we are going to issue the ordinary equity share? Okay, so now as you are issuing these shares, what you are getting against it? You are getting the money. You are getting the money. So as you are getting the money in the bank, your bank account gets debited. Your bank account gets debited. So the journal entry is bank account debited to share capital. To share capital. Then this share capital is the capital of the company. This share capital is the capital of the company, which is treated as equity or capital for the purpose of accounting. So it will be shown under equity or capital in the balance sheet or in the statement of financial position. Then the amount which you have received for share premium will also be recorded here, which is to share premium reserves, which is share premium reserves, which is also be shown under the head of equity or capital, which is also going to be shown under the head of equity and capital. So suppose if you have got $15 for the issue of a share, then $1 will go on the share capital because it is the face value, and $14 will go on the share premium reserve because this is the share premium, that is the excess amount which you have charged against the issue of shares. Okay, so this is the general entry which is going to be in the case of issue of share, and narration will be being ordinary equity shares issued, being ordinary equity shares issued, right? So this is the first adjustment for the issue of ordinary equity shares. Then we have preference shares. Share, in which there is two types of preference share, irredeemable and redeemable. So when we are going to issue irredeemable preference share, which are actually the capital and equity of the company, we need to make the journal entry as follows. Now, as in the case of ordinary equity share, you are issuing the preference share, so you are getting the money here also. So the journal entry will be bank accounts debited. The journal entry will be the bank accounts debited to preference, or to be specific we can write to irredeemable preference share account, which is classified under the heading of equity or capital. Okay, so this is going to be the journal entry for issue of irredeemable preference share, bank account debit to irredeemable preference share account. Hence the narration will be being irredeemable preference shares issued. Okay, so this is going to be the journal entry. Then we have the issue of redeemable preference share, which are going to be buyback or redeemed back by the company, which is the liability for the company. So journal entry will be bank accounts debited to redeemable preference share account, which is going to be classified under the heading of liability, because these are the liability for the company. So journal entry is bank account debit to redeemable preference share, which is the liability of the company, and hence the narration will be being redeemable preference shares issued, being redeemable preference shares issued. Got it? So what we have studied till now, we have studied the journal entry and adjustment for issue of ordinary equity share. Then we have studied about the issue of irredeemable preference share, and then issue of redeemable preference share. Now what is left with us is to record the journal entry for the borrowing and loans. So as this is the liability of taking the amount in the form of loan or borrowing, the journal entry is that you are getting the money against the loan. So entry will be very simple, which is bank accounts debited to borrowing of the loan notes account, which is going to be classified under the heading of liability, which is going to be classified under the heading of liability. Okay, so this is how we are going to record different types of capital structure for the limited liabilities company, which are capital structure, which are ordinary equity share, which are preference share, and which are borrowing or loan notes. Okay, so these are the things which we need to study in detail in chapter number 13. Okay, so if you want, I am giving you 5 minutes to read this, then we will go for the concept from our main notes. Okay, so I am putting the screen on full screen mode, you will be able to read it, then we'll go on the notes. Okay. Okay, so I hope you are done reading with the notes. Now comes to the concept from our class notes. First of all, the name of the chapter is chapter number 13, which is capital structure and finance cost. So chapter has been divided into two parts. First is regarding the capital structure and the second part is regarding the finance cost. Okay, first the information regarding the limited liability company is given to you. So what is limited liability company? A limited liability company is where investor invest in the company by buying shares and becoming the shareholders. Okay, so what is limited liability company? Where investor purchase share and becomes the shareholder. Then shareholder requires profit on their investment in the form of dividend. So whatever the money they get back from the investment is known as the dividend payment. Is known as the dividend payment or share value appreciation. So either they will get the dividend in the form of in return in the investment for which they have purchased the share, or the value of their share gets appreciated. Suppose they have purchased the share on 1 rupees face value. Suppose they have purchased the share or 1 rupees face value, but now the value of the share is $15. So this is the share appreciation, and in the similar way they will also get the share from the profit, which is in the form of dividend. Okay, then directors are hired to run the company on behalf of the shareholder. Shareholder does not run the company, they hire the directors, against which company pays fees to the director in the form of remuneration. Okay, so directors are hired to run the company on behalf of the shareholders, and shareholders are only liable to their investment. Okay, so shareholders are only liable for their investment. Suppose if I am the shareholder and I have only deposited $10 in the company, so whatever the worst situation happens to the company, I am only able to liable for that $10 and no single dollar else. So this is the highest liability that I can have. So shareholders are only liable for their investment. Okay, so they are only liable for their investment. Hence, this is known as limited liability company, because the liabilities of the owner or the liabilities of the shareholders are limited. The liabilities of the shareholder are limited. Hence, this is known as limited liabilities company. Got it? Okay. Then we have some features regarding the business entity concept of the limited liability company, then about the directors, and then about the limited liability, and regarding the shareholder, which is taken up from the ACCA study hub. So all credit goes to ACCA study hub for this chart. Okay. So if you want to read it, you can pause the screen and you can read it. Okay. Now comes to the next topic, which is the capital structure. So what is capital structure? A business's capital structure refers to the composition of its finance. Regarding the composition means combination of finance, a combination of equity shares and loan and other sources of finance that is used as long term financing, So what is capital structure? Capital structure is the structure of different types of finance sources. It can be from ordinary equity share, it can be from preference share, or it can be from borrowing or loan notes. Okay, so what is capital structure? It is the business capital structure refers to the composition of finance, combination of equity shares or debt or the other source of financing for the long term finance. Simple. Now then we have the major sources of capital. So there are three primary sources. These are not only the sources, these are the three primary. You can have many sources as there is the change in the market, but these are the three primary sources for raising the finance for the limited liability company. Now understand, what we are studying here in the notes is only about the limited liability company. We are not talking about the sole trader, we are not talking about the partnership firm. So we are only talking about the limited liability company. So there are three primary sources to raising the finance. First one is ordinary equity share, second one is preference share, and the third one is borrowing or loan notes. So these are the three types of primary sources to raising the finance. Then first we have the ordinary equity share. Which are the ordinary equity share. So the holder of ordinary share are the company's ordinary shareholders. So they are the owner of the company as the company's ordinary shareholder. Ordinary shareholders are classified as the equity capital. So ordinary shareholders amount is classified as equity capital. These are not the loan, these are not the liability, these are not the asset. Ordinary equity shares represent ownership in the incorporated entity. So these are represent the ownership. So they are the owner of the incorporated entity. So, okay, so these are the owner, which are the real owner of the incorporated entity, means the company. The key features are as follows. Now, so first we have understood what is ordinary equity share. Then we need to understand what are the key features of ordinary equity shares. Okay. Now comes to the first feature, which is the nominal value, or you can say the face value, So face value or nominal value are the same thing. So the company nominal value is usually a historic value. This means a historic value. That means a value from the history. That means a value from the past. That are originally that the original owners of the share would have been paid when the company was set up. So this is the price of share which the original owner had paid when the company was set up. That means the share at which promoter contributed to the company. Full stop. New share will often be issued at a price that is different to the nominal value. True. The new share, that means the share subsequently issued after the first issue, will often be issued at a price which is different from the nominal value. And in the case of listed company, the market price of the share is usually not the same as the nominal value. So if the company is listed, then market price will prevail, and if the company is non-listed, then means the price at which share will issued subsequently will always be higher than the nominal value. Because if the first time share was issued for $1, then next time share will not issue on $1, it will be issued at higher price because now the company has some values. Okay. So this is the concept regarding the nominal value, which is the price at which the original owner of the share would have paid when the company was set up or incorporated. Okay. Then the second feature is right to profit. So shareholders having the original owner of the company have the right to share a company's profit after all the obligation have been met. That means after paying all the expenses, after paying all the obligation, after paying everything, whatever left with the company as the form of profit, the shareholder will have some share in that profit also. That is, after paying all the obligation, full stop, the company is not required to pay dividend in its ordinary equity shareholder. That means the dividend can be paid, but this is not mandatory by law. That means the company is not required to pay dividend. That means it is not necessary. So even if the company has profit and they are left with some profit, they are not required, that means they are not mandated by any law to pay the dividend. So dividend is a right but not the obligation of the company to pay you every time. Okay, so if they have the profit they will pay, if they don't have the profit they will not pay the dividend to the shareholder. So what is right to profit? Right to profit is the shareholder have the right to share a company's profit after all obligation have been met. So first you need to pay off all the expenses, pay off the amount to the different shareholder, then pay off the dividend, pay off the interest, and then you are left with the amount is going to be the amount for which dividend can be paid. Then comes again the right to, this is corrected, this is right to vote. Okay, this is right to vote. Then we have right to vote, which is it gives shareholder the right to vote on the company's important decision. As the shareholder, that means the ordinary equity shareholder are the real owner of the company, so they have the right to vote on the important decisions of the company, whether you need to have this director or not, whether you need to appoint certain type of auditor or not. So they are going to be involved in that decision by voting rights. Okay. Then we have share of asset if the entity bind up. Bind up means if the entity is going to be closed off, okay, or going to be liquidated. So share of asset. Now shareholders have the right to receive all remaining cash after all the obligations have been met. So suppose if the company is going to be binded up and you are left with some cash after paying all the liabilities or all the obligation, you are left with some cash, then that amount will be distributed to the ordinary equity shareholders. Full stop. If a company has been forced to bind up because it has run out of the money, if the company is forced to write off because it has run out of the money, comma, there is usually no cash left and ordinary equity shareholder will have to lose their investment. If suppose in the case the asset has been sold for the amount which is less as the obligation is there, so they are left with no money and the original shareholder will have to lose out their investment because there is no money left. Okay. Now suppose if the asset has been sold for $100 and the liability has been paid for $90, so the remaining $10 will be distributed to all the shareholders. But if in the case the asset has been sold for $100 and the liabilities are for $110, so there is no money left because it is negative. So shareholder will have to lose out their investment. And what amount of investment they have to lose out? Which they have invested, because this is the limited liability company, so their liability will only be limited to the amount which they have invested in the share of the company. Got it? Now let's understand the journal entry for the issue of ordinary equity share. So what will be the accounting entry, or to be specific, what will be going to be the journal entry for the issue of ordinary equity share? So the journal entry will be bank accounts debited, because you're getting the money against the issue of shares, so you are getting the money. So bank accounts debited to ordinary equity share capital, to ordinary equity share capital or to share capital, which will be classified as equity or capital, and to share premium account, which is the difference between issue price and the nominal price, or the difference between issue price and the face value, will also be disclosified under the head of equity or capital. Okay, so this is going to be the journal entry for the issue of ordinary equity share, that is bank account debited to ordinary equity share to share premium account. Correct? Now as we have understood what is the ordinary equity share, then we go to the other source of financing, which is preference shares. So what is preference share? So preference share are another form of capital that a company might issue, so this is not mandatory to be issued, this is the option that company has. So the company might issue the preference share also, although less common than the issue of ordinary equity share. So company mostly issue ordinary equity share and not the preference share. Okay. The key features of preference shareholders are, as follows. First, there are two types of preference share. First one is redeemable preference share and the another one was irredeemable preference share. So there are two types of preference share, redeemable and irredeemable. First of all, understand what is redeemable. So redeemable preference shares are the shares which will be redeemed or repurchased by the company. There is an obligation to redeem, which means they are classified as liability. The redeemable preference share are the share which the company is supposed to redeem back or repurchase. So this is the obligation by the law. So it is the liability for the company. It has been classified as the liability because company is supposed to repurchase them or redeem them back. So when the irredeemable preference share are issued, the journal entry is bank account debit to redeemable preference share. The journal entry is bank account debit to redeemable preference shares. Okay, so this is simple for redeemable preference share. Then comes to another form of irredeemable preference share, which are the shares which will never be redeemed. These are the preference shares which are never going to be redeemed or repurchased by the company unless it is bound up. So until the company is going to be closed off or is going to be binded up, there is no such obligation to redeem them back or repurchase them. There are a permanent form of capital categorized as equity. So these are the permanent form of capital which are classified as equity, similar to ordinary equity share. So these are classified similar to what ordinary equity shares are classified. Okay. So irredeemable preference share are classified as the equity. Then as there is no obligation to redeem them, so there is no such obligation by the law or act to redeem them back, so these are classified as the equity. Now the journal entry for issue of irredeemable preference share are going to be the bank account debit, because in both the cases you are getting the money. So bank account debited to irredeemable preference share, which will be classified as equity in the statement of financial position or in the balance sheet. Okay, so journal entry is very simple, bank account debit to irredeemable preference share which will be classified as equity in the balance sheet or statement of financial position. Simple. So this is about preference share adjustment. Now the question which will be coming to your mind is, sir, you have made us understood what is ordinary equity share and their journal entry. You have made us understood about the journal entry of preference share, but you have not told us about what is preference share. So that is also covered in our syllabus, which is the features of preference share. First, which is right to profit. First, which is right to profit. So preference shareholder have the right to receive a fixed dividend each year. They have the right to receive a fixed dividend each year until unless like the equity ordinary share where they have the right but it is not the legal requirement. So if they have the profit, they will receive, and redeemable preferential and the preference share will receive the dividend even if the company is not having the profit. So it is the right to receive fixed dividend each year. So that is even in the case of, or you can write right is by the law. So they are going to receive the dividend whatever the case it is. Then this is calculated as the fixed percentage of the preference share par value or face value. A company must pay preference share dividend before it can pay to ordinary equity dividend. So the dividend of preference share will always be paid before the dividend of ordinary equity share will be paid. Hence they are known as preference share because they are getting the preference in terms of dividend. They are getting the preference in receiving the dividend. Hence they are known as the preference shares. Okay, so preference share and ordinary equity share are different from each other because preference share will get their share of dividend before getting the ordinary equity shares. Okay, now this line, that is this dividend is going to be calculated as the fixed percentage of the preference share. Suppose you are issuing the preference share as 8%. So the name of preference share will be 8% preference share. The name of the share will be 8% preference share. Suppose you are issuing 1 lakh share of the value $10. Suppose you are issuing 1 lakh share of the value of $10, then the amount of preference share will be 10 lakhs dollar. The amount of preference share will be 10 lakhs dollar, and the amount of dividend will be 10 lakhs multiplied by 8%. The amount of dividend will be 10 lakhs multiplied by 8%. That means 80,000 is the amount of dividend which you are going to pay every year. Is the amount of dividend which you are going to pay every year. Hence, they are known as the fixed dividend. They are going to be known as fixed dividend. So this is the fixed amount which you need to pay every year. Okay. So this is the first feature which is right to vote. Then comes right first feature which is right to profit. Then comes right to vote, which is preference shareholder do not have any voting right attached, as preference shareholder are not the real owner of the company. The real owners are ordinary equity shares, so they have the right to vote, but preference shareholder do not have any right to vote. They are only having the preference over the dividend. Okay, they are only having the preference over the dividend payment. They are not having any voting right, so they do not have any voting right in the important decisions of the company. Okay, then shares of asset if the entity binds up. Then share of asset if the entity binds up. Preference shareholder take higher priority than ordinary equity shareholders. Hence they are known as preference. They have the higher priority than ordinary equity shareholder. If a company is bonded up, it means that the preference shareholder will be paid the face value of their investment before the ordinary equity shareholders can claim any part of their investment if the entity cease trading. Okay. Now, what does this mean? Suppose if your assets are sold for $100 and your liabilities are paid for $80, then you have remaining $20. So first this $20 will be used to pay the preference shareholder. First this $20 will be used to pay the amount invested by the preference shareholder on the face value of their investment. After this, whatever the amount is left will be given to ordinary equity shareholder. Okay, so first priority is to pay back the preference shareholder, then only the equity shareholder will get the money back. Okay, so they are getting the preference over dividend, and they are getting the preference over share of asset if the entity binds up. The only thing which they are not getting, the only thing which they are not getting is the right to vote. So they are not getting right to vote unless they are getting the preference in dividend payment and the preference in share of asset if the entity binds up. Okay, so this is the all about preference share, which are of two type, redeemable and irredeemable. Then we have borrowing and loan notes. The third, the last but not the least form of capital financing. Okay, so then we have third form of capital financing, which is borrowing or loan notes, which is company can borrow from lenders or issue loan notes to raise their capital for the business. Company can borrow to lenders or issue loan notes to raise their capital for the business. Borrowings are classified as liabilities. We all know borrowings are classified as liability for a business and have the following characteristics, or you can know, or you can also say that have the following features. Features and characteristics are same. First, it carries a fixed rate of interest payable by the company to the lender each year. Okay, so each loan have a fixed rate of interest which is going to be paid off each year by the company. Second, principal amount will be redeemed at a fixed rate in the future. Okay, so suppose if the loan is for 10 years, so each year you are going to pay back the interest, and at the end of the 10th year you are going to pay back the principal amount, which was the original amount which you have taken in the form of borrowing or in the form of loan notes. Okay, apart from this, one more feature is there, that loan note can be secured. What I am saying, that loan note can be secured, that is an asset can be used to have the loan secured. Our asset can be mortgaged against the loan, so that in case of failure to pay the loan, then asset can be sold and the amount can be recovered. Okay, so loan note can be secured by the asset. Okay, now comes to the accounting treatment, which is journal entry for borrowing or loan note, which is bank account debit, because you are taking the loan, so what you are getting? Money. And when you are receiving the money in your bank account gets debited. So bank account debit to borrowing or liability account, bank account debit to borrowing or liability account. So this is the journal entry which is going for the loan or borrowing loan notes. Okay, so we have studied all three types of capital structure for the limited liability company, which are ordinary equity share, preference share, and borrowing and loan notes, and their journal entries. Then we have this beautiful chart as also given by the ACC Study Hub. Okay, so in this chart, the all things are given, which is capital structure. First, shares and equity. Then we have two categories: ordinary share and irredeemable preference share. Ordinary preference share will get share appreciation or dividend, and irredeemable preference share will get dividend. Okay, then we have debts we have borrowing and redeemable preference share, because redeemable preference share are the share which are going to be redeemed, hence treated as liability. So borrowing and borrowings and redeemable preference share are treated as liabilities, and the borrowing will get interest and redeemable preference share will get dividend. Okay, so this is the chart which you can refer. If you want to read this, you can just pause the screen and take the screenshot. Okay, then we have other topics which are left for this class are right issue and bonus issue. Then we have cost of capital for business. Then we have dividend, how dividend are going to be treated in the books of account. Then we have interest cost for borrowing. Then we have equity component. Then we have topics about reserves and non-distributable reserves. Then we are going to end this chapter with the statement of changes in equity. Okay, so I think these topics are going to be covered in the next class. So this is the good point to end this class. We will see in the next class. If you have any doubt, just drop the message in the group or just DM me. I will solve all your doubts. Okay, so this is all for this class. We will see in the next class. Thank you.